Imagine spending 30 years paying off your mortgage. You make the final payment. The bank sends a letter. You celebrate. You tell your family, we're finally debt-free. For the first time in decades, the house is completely yours. No mortgage. No lender. No monthly payment. You feel financially secure. But what if I told you that this exact moment, the moment most people consider financial freedom, could actually be the beginning of a financial trap? And what if the very asset you've spent your entire life trying to own is quietly costing you hundreds of thousands of dollars in lost wealth? Today we're going to explore why many wealthy investors see a paid-off house very differently from the average person. And before you get angry and click away, I'm not saying homeownership is bad. I'm not saying you should sell your house. But by the end of this video, you'll understand why a fully paid-off home can become one of the most dangerous assets in a person's financial life. And the reason has almost nothing to do with real estate itself. The dream everyone chases. For generations, we've been taught a simple formula. Go to school, get a job, buy a house, pay off the mortgage, retire peacefully. It's one of the most accepted financial goals in society. And honestly, there's a good reason why. A paid-off home provides emotional security. Nobody can raise your mortgage payment. Nobody can repossess the house because of missed loan payments. You sleep better at night. That feeling is real. But here's the problem. Financial decisions made for emotional comfort don't always create financial strength. Let's imagine two people. Person A spends 30 years aggressively paying off a house. Every extra dollar goes into the mortgage. Every bonus. Every tax refund. Every spare penny. By age 60, the house is completely paid off. Meanwhile, Person B follows a different strategy. Instead of rushing to eliminate low-interest debt, they invest extra cash into productive assets. Stocks, businesses, index funds, cash flow investments. After 30 years, Person B still owes some money on the house. But their investments have multiplied many times over. Who is actually wealthier? Most people automatically choose the paid-off homeowner. But that's often not the correct answer. Because wealth isn't measured by how much debt you eliminated. It's measured by how many assets are working for you. And that's where the hidden danger begins. The problem of dead equity. Let's talk about something wealthy investors hate. Dead equity. Dead equity is money trapped inside an asset that isn't producing income. Imagine your home is worth $500,000. You owe nothing. Sounds amazing, right? But that means $500,000 is sitting inside walls, floors, windows, and a roof. Can you buy groceries with it? No. Can you pay medical bills with it? No. Can it generate monthly cash flow? Usually not. The money exists, but it's locked away. Think about this. If someone handed you $500,000 in cash today, would you immediately put all of it into a single non-income producing asset? Most people wouldn't. Yet that's exactly what happens when enormous equity builds up in a home. The house may be valuable, but the equity itself often remains financially inactive. Investors constantly ask one question. How hard is my money working? A paid-off house often works much harder for your lifestyle than it does for your finances. And that's a distinction most people never learn. The opportunity cost nobody talks about. Here's where things get really interesting. Let's discuss opportunity cost. Opportunity cost is the value of what you give up when choosing one option over another. Suppose you pay an extra $1,000 every month toward your mortgage. Over decades, that's a substantial amount of money. But what if that same money had been invested? What if it earned returns year after year? What if those returns compounded? The difference can become staggering. This is why some wealthy individuals aren't obsessed with paying off low-interest debt early. They focus on where capital produces the highest return. The average person asks, how fast can I eliminate debt? The investor asks, where can my money grow the most? These are very different questions, and they often lead to very different outcomes. The irony is that many people become house-rich but investment poor. On paper, they're worth millions. In reality, they're struggling with cash flow. That's a dangerous position to be in, especially during retirement. The retirement trap. Now let's talk about a scenario that's becoming increasingly common. Meet a retired homeowner. The house is worth $800,000. Mortgage balance? Zero. Retirement savings? Limited. Monthly income? Tight. This person appears wealthy. But appearances can be deceiving. Because wealth trapped in a house doesn't automatically pay monthly expenses. Property taxes continue. Insurance continues. Maintenance continues. Repairs continue. A new roof. A broken HVAC system. Foundation problems. Plumbing issues. The expenses never stop. And suddenly the homeowner faces a painful reality. They have significant net worth, but insufficient liquidity. In other words, they own wealth, but they can't easily use it. This is one reason why some retirees end up taking loans against their homes, downsizing, or selling property altogether. The asset that was supposed to provide freedom can become a source of financial pressure. Not because homes are bad, but because too much wealth became concentrated in one place. The hidden risks of concentration. Imagine investing every dollar you own into a single stock. Most financial advisors would call that risky. Yet many families do something surprisingly similar. A huge percentage of their net worth sits inside one property, one neighborhood, one local housing market, one physical asset. If that market slows down, your wealth slows down. If the area declines, your wealth declines. If taxes rise, your costs rise. Diversification exists for a reason. The wealthiest investors spread risk. They own multiple asset classes, businesses, stocks, real estate, cash reserves, private investments, different income streams. A paid-off house can unintentionally create concentration risk. And concentration risk often goes unnoticed because the house feels familiar. People trust what they see every day. But familiarity doesn't eliminate risk. The psychological illusion of safety. Now we're approaching the most important part of this entire discussion. The greatest danger isn't financial. It's psychological. A paid-off house creates a powerful feeling of security. And security can sometimes reduce urgency. People stop investing aggressively. They stop building additional assets. They stop pursuing growth. Why? Because they feel they've already won. And emotionally, that's understandable. But financially, it can become dangerous. The house becomes a comfort zone, a symbol of success. And sometimes symbols distract us from actual financial performance. The wealthy often understand something different. True financial security comes from cash flow, income-producing assets, investments that continue generating money whether you're working or not. That's a very different type of security than simply owning a valuable property. The real lesson. So, is a paid-off house actually a bad thing? Absolutely not. For many families, it's a wonderful achievement. It's stability. It's pride. It's peace of mind. But here's the key lesson. A paid-off house should not be mistaken for complete financial freedom. Because a house can provide shelter without providing income. It can increase net worth without increasing cash flow. It can make you look wealthy while leaving you financially constrained. The danger isn't the house. The danger is believing the house alone is enough. The most financially resilient people don't rely on a single asset. They build multiple streams of wealth, multiple sources of income, multiple layers of security. And that's the mindset shift that changes everything. So the next time someone says, "My house is paid off, so I'm financially free," ask one simple question. If your house disappeared tomorrow, what assets would still be paying you? Because real wealth isn't measured by what you own. It's measured by what continues working for you, even while you sleep. And that may be the most important financial lesson you'll ever learn. If you found this perspective valuable, subscribe for more deep dives into wealth, investing, financial psychology, and the money lessons most people never hear. And tell me in the comments, would you rather own a fully paid-off house or a portfolio of income-producing assets worth the same amount? The answers might surprise you.